Debt. It's a word that we associate with personal loans, mortgages, or student repayments. But on a global scale, debt is far more sinister. It's a weapon, a way to control nations, to strip them of their resources and enforce a modern form of colonialism. Today, on the Left Library, we'll uncover the secret history of debt warfare. We'll show how colonial powers force countries to pay for their own freedom, how international financial institutions trap nations in cycles of debt even through to today, and how mechanisms like the CFA franc keep economic imperialism alive today. Along the way, we'll explore insights from Marxist thinkers such as Samir Amin, David Graeber, and Eric Toussaint. When colonial powers left these countries, they didn't just walk away. They demanded payment for their so-called losses. Freedom for many countries came at a devastating financial cost. Take Haiti as the first example. After its revolution in 1804, Haiti was the first nation to abolish slavery and declare independence. But France demanded 150 million francs. That is the equivalent of about $21 billion today. This was for compensation, they called it, for the lost profits of French slave owners. Haiti paid the debt for over 120 years, forcing the country to take out additional loans from French and US banks. By the time that the debt was finally repaid in 1947, Haiti's economy was in ruins, leaving the nation impoverished to this day. But Haiti wasn't alone. Many African nations faced similar demands after gaining independence in the mid-20th century. For instance, Algeria was forced to negotiate with France over financial reparations before its independence in 1962. Infrastructure and industries built during colonialism, designed to benefit European settlers, now became liabilities for the new post-colonial government. Colonial debt wasn't just financial, it was political. By keeping former colonies in perpetual repayment, colonial powers ensured that these nations remained dependent on the former colonial power. Eric Toussaint, in his book The Debt System, calls this a, open quote, transition from colonialism to neocolonialism, end quote. Nations were no longer directly ruled, but they were still controlled. In the mid-20th century, a new form of debt warfare emerged. After World War II, global financial institutions like the IMF, which is the International Monetary Fund, and the World Bank were created, claiming to promote economic stability and development. But in practice, they became the new tools of exploitation. Countries in the global south took out loans to rebuild roads, dams, and schools, believing that they were investing in their futures. But these loans came with conditions. To qualify, nations had to agree to something called structural adjustment programs, or SAPs for short. These programs required countries to 1. Cut spending on public services like education and healthcare. 2. Privatize industries, selling them off to foreign corporations. And 3. To remove tariffs and protections for local businesses, exposing them to competition from wealthier nations. Let's look at Jamaica as a key example of this. In the 1970s, Jamaica borrowed heavily from the IMF. By the 1980s, the country was spending more on debt repayments than on education and healthcare combined. SAPs forced Jamaica to slash public spending, leading to overcrowded schools and hospitals. The government was also pressured to open its markets, devastating local industries. Farmers, for example, couldn't compete with cheap imports, pushing many farmers into poverty. David Graeber, in his book Debt, the First 5,000 Years, explained this system as a form of, open quote, tribute, end quote. Wealth is systematically drained from debtor nations to the creditors, reinforcing the global system of inequality. As David Graeber writes, open quote, debts are supposed to be repaid, but under this system, repayment becomes a method of perpetual exploitation, end quote. One of the clearest examples of how debt and economic domination persist today is the CFA franc zone. The CFA franc is a currency used by 14 African countries, introduced by France in 1945 and still controlled by the French Treasury today. While these 14 nations are technically independent, their economies are tightly bound and dependent on France. So, how does it work, the CFA franc? Well, countries using the CFA franc must keep 50% of their foreign reserves within France's central bank, meaning they don't have that money within their own national economy. Secondly, France controls the monetary policy, including the value of the CFA franc, often to the detriment of African exporters. And thirdly, the currency's fixed exchange rate with euro makes imports from France cheap, but exports from African countries uncompetitive. This CFA franc system effectively ensures that nations remain economically dependent. Samir Amin argued that the CFA franc zone is a form of neocolonialism, keeping African economies locked into serving the needs of European markets. For example, Senegal, a member of the CFA franc zone, spends more on importing French goods than it earns from its own exports. This inability to control its own currency has led to stagnation in domestic industries, forcing Senegal to rely on foreign aid and loans just to survive. But the impact of debt warfare isn't just economic, it's deeply human. When nations are forced to prioritize debt repayments, ordinary people suffer. Let's return to Zambia. In the 1990s, under IMF pressure, Zambia privatized its copper mines, the country's most valuable resource. Foreign corporations bought these mines at an astoundingly low price, and profits were then siphoned out of the country. Meanwhile, public services in the country collapsed. Hospitals lacked medicine, schools couldn't pay teachers, and unemployment soared. Feminist scholar Silvia Federici, in her book The Caliban and the Witch, highlights how debt disproportionately affects women. When public services are cut, women take on the unpaid labor of caring for the sick and educating children. Debt, Federici argues, reinforces not just economic inequality, but also gender hierarchies. So why and how do systems like this exist? Well, according to Samir Amin, debt ensures that wealth continues to flow from the periphery nations, which are the poor nations of the global south, to the core, which is the wealthiest nations of the global north. In his book, Accumulation on a World Scale, Amin argues that debt is the modern form of colonial exploitation. Instead of extracting resources through direct rule, as used to happen in the times of empire, wealth is today extracted through loan repayments, interest on those loans, and privatization. Shockingly, between 1980 and 2008, countries in the global south paid $4.2 trillion to the global north in debt service, which is interest and principal repayments on that debt. That's nearly 3 times the amount of aid that they received within that same period. In effect, poor nations are financing the wealth of rich nations. To quote from Samir Amin, debt is not just an economic mechanism. It's a political tool to maintain the global hierarchy of wealth and power. End quote. Despite the devastation caused by debt warfare, resistance is growing. In 2005, global campaigns like the Jubilee Debt Campaign pressured wealthy nations to cancel $100 billion of debt for the 18 poorest countries. While this was a victory, it was only a fraction of what's still owed. Some nations have taken matters into their own hands. Bolivia, under President Evo Morales, rejected IMF loans and nationalized its own gas industry. By using its resources for public investment, Bolivia managed to reduce poverty by 25% in a decade, proving that alternatives are possible and tangible. Samir Amin offered another vision of how to navigate this crisis: delinking. Delinking means breaking free from the global capitalist system and prioritizing local development. Amin believed that only by rejecting debt dependency could nations truly achieve independence. The quote from Samir Amin: "Delinking is not isolation. It is the refusal to participate in a system that's designed to exploit you." End quote. So, what does this history of debt warfare teach us? Firstly, debt is never neutral. From colonial reparations to IMF loans and the CFA franc, debt has been used as a weapon to control nations and extract their wealth. Second, resistance is possible. By challenging these systems and being aware of these systems, nations can reclaim their sovereignty and, in the future, invest in their people. Thank you again for watching the Left Library today. If you found this video helpful or enjoyed it or even just made it this far, please do leave us a like, think about subscribing, and maybe even share it to some people that you think might enjoy. And until next time, let us know what you want to hear, whether it's more hidden histories or more theory or theory applied within certain places. Until next time, this has been the Left Library, your home for simplified political theory, and we'll see you again soon.